Hello, everyone, to another episode of the VMC Inc. Financial News Network. I'm Victor Campos. So today is February 7th, 2016. Happy Super Bowl Sunday. Well, besides thinking about sports, what else should you be thinking about? How about retirement? So yes, everyone should be thinking about retirement, even millennials, even those born between 1980 and 2000. So if you're a millennial, this video is for you because you want to think about your retirement, even though it's years and years and years away, because only you can make yourself rich. You're not going to hit that Powerball number. You're not going to get an inheritance from a rich uncle. You're going to become the rich uncle or aunt one day, and here's the way to do it. So I'm going to recommend to set up a retirement date mutual fund. Now that sounds complicated, but it's not. There's many ways to do it, but here's one way. So we recommend Vanguard Financial. They're a great company. It's been around a long time, and they really know how to handle your money. So Vanguard.com. I'm going to go to the website. I'm a personal investor, so I'll click on Vanguard's website for personal investors. There's a lot to look at here, a lot to read and educate yourself about, but no worries. We're going to go over to the section on investing, and we'll look at their Vanguard mutual funds. Basically, a mutual fund is everyone puts their money into this fund and it grows, and with more money comes more power for it to be worth more in the future. So from here, then I'll look at choose your mutual funds. Again, it'll give you a lot of information, get help, but I'll jump down to browse Vanguard's complete fund lineup, and they've got lots of them to choose from. And so there's different ways to screen this data, what sort of asset class, all of this stuff, minimums. Here's the easy way to do it. Take your birth year and then add 60. So I'm going to pull up my calculator here. Let's say you were born in 1996, which is of course impossible because that's when I graduated high school. But let's say you were born in 1996. You want to then add 60 years to that because you want to retire. Maybe when you're 60, 65, whatever, you want to retire at some point. You don't want to work your whole life. So let's say retiring 60 years after you're born. So that comes out to 2056, the year 2056. So that's our retirement target date. We look here on the Vanguard funds, and we're going to find a section, balanced funds, target date. So these are funds that you're going to invest in that will mature at a target date. So we said we're going for 2056. So let's see here, 2050, 2055. 2055 is close enough. So this is what your mutual fund will be. Target retirement 2055, symbol VFFXV. So what is this anyway? I'm going to click on it. This will give me all the information about the Vanguard Target Retirement 2055 Fund. This is a fund that offers a diversified portfolio within a single fund that adjusts its underlying asset mix over time. So basically, the secret to wealth is to invest in stocks and bonds. But you don't want to pick the wrong stock, the wrong bond. So something like a mutual fund is going to do the hard work for you. And Vanguard funds are some of the best mutual funds to invest in because they're diversified and have great returns and low cost. Because it does cost money to make money. So let's check here in more detail. The 2055 fund invests in 4 Vanguard index funds holding approximately 90% of assets in equities and 10% in bonds. So 90% stocks and 10% bonds. You may wish to consider this fund if you're planning to retire between 2053 and 2057, which is what our goal was of 2056. Okay, so you need a minimum investment of $1,000. So you purchase shares in this fund of $1,000. And what you get for that is a fund that gives you more reward in the long term with more risk, yes, but that's very common. More risk gives you more reward. Less risk, less reward. What does that mean a little bit more tangibly? In this chart here, if you had invested $10,000 back in 2010, put those $10,000 into this fund and just kept that in there, now 6 years later, it would be worth about $16,000. That's a much better result than a plain old bank. You would not be getting $6,000 out of your investment in a bank, but you will out of a mutual fund like this one. And yes, there are ups and downs and ups and downs and lots of ups and some downs, and maybe some more downs are coming. You don't know. But notice this trends upward. It always trends upwards. So you're going to ignore the bumps in the road to look at the horizon of 2056, because the rest of the information that we get here will show you why this is a good investment. Let me look at it on another screen up here under price and performance. We invested our money in this fund and only looked at it 1 year later. Yes, we lost value in our fund, but you're not going to retire in 1 year. If we looked at our fund 3 years later, it would give us a return of 6.11%. You're still not going to retire in 3 years. If you look at it 5 years, 6.73. And eventually when this fund is 10 years old, we'll get a result there. But if we had invested on day one when this fund was created, 2010, it would give us a return of 9.23%. That's huge compared to a bank. So again, you can see the various data here, looking at things in 1 year increments. Don't even try. 3 years, not really. 5, 10, 15 years, etc. We're holding out until 2056. Your money is going to grow and grow and grow when you invest. You have to start off with at least $1,000 in this fund, but your strategy is that you're going to invest as much as you can whenever you can to feed this fund. Instead of putting it into a bank, you're going to feed your fund. Now there are fees, because it takes money to make money, but Vanguard funds are often some of the most affordable funds out there. So Target Retirement 2055 has an expense ratio of 0.16%. So that's how much it's going to cost for you to invest in this fund. On average, similar funds are going to be 0.41%. So with $10,000 invested over 10 years, that's costing you $721 from the other guys and only $284 from this Vanguard fund, VFFVX, so $436 savings. After your initial investment of $1,000, then you can just do additional investments of at least $1. You can create a general account, or maybe a more tax-friendly IRA account, or an educational savings account. Check out our other video about our discussion on IRAs and why those would be valuable. But it takes money to make money. And how is this going to make you money? Well, if you look at the portfolio, it's about 89.92% stocks, 10.08% bonds. And that money is being invested in these 4 index funds. Index funds are great because they really work in the long term. They're very affordable. They're automated. So we've got Vanguard Total Stock Market Index Fund, Total International Stock Index Fund, Total Bond Market, and Total International Bond Market. So this is weighted towards stocks and a little bit of bonds. As this fund matures, as we get closer to 2030, 2040, 2050, the ratio will change automatically to more safer bonds when necessary, less risky bonds. This fund is worth $2.4 billion. And to find out exactly the stocks and bonds that are being invested, I'm going to do a quick search here. What is in the Vanguard Total Stock Market Index Fund Investor Shares? I'm going to do a quick search here. That should pull me up over to Vanguard's site somewhere. But here we go. Vanguard Total Stock Market Index Fund, VTSMX. Let's see, large blend. So it's investing in large companies. It's risky, but gives you more reward. Blah, blah, blah. There's your money growing. Again, $10,000. 10 years later would be worth $20,000. Try that at a bank. But what I want to see is what's in the fund. You can go over to the portfolio. This will break it down. This has got Apple stock, Alphabet, also known as Google, Microsoft, Exxon, General Electric, Johnson & Johnson, Amazon, Berkshire Hathaway, Wells Fargo, JP Morgan, and many more. You can go down to the full portfolio holdings to see every detail. But all of these huge, profitable, valuable companies are helping you grow your money. You're investing in VFFVX, the 2055 Retirement Fund, which your money then goes into buying pieces of all of these companies, all of these valuable, profitable companies. It's diversified. Your money is going to be spent on basic materials companies, financial companies, healthcare companies, technology companies, etc. Because of diversification, if one sector goes down, like oil, it's not going to take down all your value, because in this case, it's 6% of the fund. And when consumer goods companies do well, your money will do well as well. So that's the beauty of a mutual fund. So it may be a while till you retire, but this is something you want to think about, and it does require an initial investment, $1,000. It does have fees, but your money is growing. Better than a bank. We've also got distributions and dividends, 59 cents per share. So little by little, the fund is going to grow. The fund is going to make you more money. And by the time you retire, in the far future of 2056, in the unimaginable future of 2056, you will have a good retirement. And 2056 is not that far away. I remember thinking the year 2000 was so far away. I was going to be 22 years old in the year 2000. Unbelievable. And now we're 16 years past the future. So you might as well start thinking about your own far future, because the only person that's going to make you rich is yourself. So this has been Victor Campos for the VMC Inc. Financial News Network. See you next time.